Welcome to the deep dive. We've put together this session just for you, especially if you're getting ready for Chapter 16 of the ACCA Financial Reporting exam. Today, we're tackling events after the reporting period. Okay, let's unpack this. It's actually quite important stuff.
It really is. And what's fascinating here, I think, is the role of IAS 10, that's International Accounting Standard 10. Its whole objective, basically, is to be super clear on what these events are and, crucially, how we should treat them in the accounts.
Right, because you need that clarity for good financial communication.
Yeah,
Stops companies maybe hiding things, yeah.
exactly. It ensures the financial statements give a true picture of the company's situation at that specific point in time, the year end. It prevents, misleading investors with big news that breaks just after the accounting date.
That makes sense, because the world doesn't just stop on December 31st or whenever the year end is. So IAS 10 defines these events after the reporting period as significant things, good or bad, right, that
Yeah.
happen between the year end date.
And the financial statements are actually authorized for issue.
Yeah. And the big question then is, what do you do about them?
Well, that's the core challenge, isn't it? Do you, go back and actually change the numbers in the balance sheet or income statement? Or do you just need to tell people about it in the notes? That's where the whole idea of recognition and measurement comes in. It sets the rules.
Ah, okay. And deciding whether to change the numbers or just add a note. Here's where it gets really interesting, I think. This is the big split, right, between adjusting events and non-adjusting events.
That's the one. And it's not just jargon. It makes a huge difference to the story the accounts tell.
So how do we tell them apart? Let's start with adjusting events.
Okay, so adjusting events. Think of these as providing new evidence about conditions that already existed right at the end of the reporting period. The classic example is a major customer going bankrupt after your year end. But, and this is the key bit, the financial problems that caused the bankruptcy, they were already there before your year end. Maybe they owed you a lot, payments were late.
Ah, so the bankruptcy just confirms something that was already brewing.
Precisely. It confirms a loss or an impairment that really relates to the period before year end. So for these, you must go back and adjust the figures. You'd probably need to increase your allowance for doubtful debts, for instance. It makes the past reporting more accurate.
Okay, got it. Adjusting means change the numbers because it relates to the before. So what about the other type, non-adjusting?
Right, non-adjusting events are different. These signal conditions that arose completely after the reporting period ended, brand new information. Imagine a big fire destroys your main warehouse 2 weeks after the financial year end.
Oh, wow. Okay.
That's obviously massive news. But at the year end date, the warehouse was standing, it was fine. The fire hadn't happened.
So you wouldn't delete the warehouse asset from the balance sheet for the year that just ended?
Exactly not. The fire damage didn't exist then. So you don't change the main financial statement figures for the past year, but you absolutely must disclose it. You tell users about the fire in the notes. It's crucial information for understanding the company's future, even if it doesn't change the past numbers.
That distinction is paramount then. It
Yeah.
really shapes how you read the accounts. Now, our sources also mention dividends and going concern under this topic. How do they fit into this adjusting versus non-adjusting idea?
Good question. Take dividends. If a company just proposes a dividend after the year end, that decision, that obligation didn't exist at the year end. So it's non-adjusting. You don't adjust retained earnings for that period. You disclose it, of course.
But if it was declared before year end, even if paid later.
Then it is an obligation that existed at year end. That would potentially be adjusting, depending on the specifics. And going concern, well, this is a big one. If a major event happens after year end, maybe you lose your biggest customer, or that fire we mentioned is catastrophic, and it suddenly throws real doubt on whether the company can even continue trading. That's a huge issue. Even if the event itself is non-adjusting for the main numbers, the implication for going concern is massive. It requires serious disclosure, maybe even preparing the accounts on a different basis altogether if the going concern assumption isn't appropriate anymore.
Wow, okay, so even non-adjusting events can have profound implications. Which brings us to disclosure, right?
Absolutely. If we connect this to the bigger picture, disclosure is vital. Even if the numbers aren't changing, users need to know what's happened.
So what does this all mean for disclosure? What needs to be in the notes?
Well, beyond just general stuff, IAS 10 is specific about significant non-adjusting events. You need to state the nature of the event, what happened, and, if you can, an estimate of its financial effect.
What if you can't estimate it?
Then you have to state that an estimate can't be made. Honesty is key. And, of course, any disclosures about going concern worries triggered by these post-year-end events, it's all about giving users the full picture to make informed decisions.
Got it. Transparency is everything.
It really is. And, this raises an important question, I think, for you, the listener. Beyond just getting through the exam, how does really grasping this difference, adjusting versus not adjusting, as IAS 10 defines it, how does that sharpen your ability to look at a set of accounts and critically assess what's really going on with the company's financial health and its future prospects?
That's a great takeaway. It's not just ticking boxes. It's about deeper understanding.
Exactly. It helps you see beyond the headline numbers.
Fantastic point. Well, that's been a really useful exploration of events after the reporting period. Thanks for diving deep with us today. Keep up the great work with your studies, keep exploring, and keep mastering financial reporting.